welcome to Moneylife News and Views. I am Debashis Basu. This week, we are obviously talking about the biggest incident of the entire last week and part of the week before, which is the blow-up of FTX. Now, since the first week of November, the spectacular bonfire of FTX, what is supposed to be a crypto exchange, and it's one of those funny things which grown bigger and bigger and bigger, and then it finally flamed out. Now, that story has kept us enthralled because FTX was valued at about $32 billion just a few months ago and was funded by some of the biggest names in the global financial markets, such as Sequoia, Temasek, which is a Singapore-based private equity and public equity giant, Ontario Teachers Pension Plan, SoftBank Group, and hedge funds Third Point and Tiger Global. All of them funded this company, which grew to $32 billion of valuation, not listed, just paper wealth. And that company suddenly declared bankruptcy on 11th November. Since then, bizarre stories of worthless token shown as assets, billions of dollars of assets, and the sudden withdrawal of cash before bankruptcy, again, billions of dollars, the fake altruistic halo of the frizzy-haired wonder boy, Sam Bankman-Fried, known as SBF, and the complete lack of controls, checks, and balances at FTX have stunned the world. What are the lessons from this saga of gigantic fraud? FTX surely would not have grown to this size and flamed out had two of the most important players in the system, which is institutional investors and regulators, not drifted away from first principles of their own respective area. What are these first principles? Now, first look at the first set of investors, first set of players, which is the investors who really pumped money into this fraud and made it so big. As a Wall Street columnist, Jason Zweig wrote about FTX, SBF, that is Sam Bankman-Fried, may have been at the center of what went wrong, but he did not act alone. Behind him lies a vast ecosystem of fantasy and fakery. He calls it the investing business. In case of FTX, the finest investors failed to do a basic due diligence of the operation that FTX was running. Now, how do we know that? John Ray III, who has been appointed as the CEO by in the bankruptcy process, said that I have over 40 years of legal and restructuring experience. I have been the chief restructuring officer or CEO in several of the largest corporate failures in history. I have supervised situations involving allegations of criminality and malfeasance, but never in my career have I come across such complete failure of corporate controls and complete absence of trustworthy financial information as has occurred here. From compromised systems of integrity and faulty regulatory oversight, and we're going to come to this next, to the concentration of control in the hands of a very small group of inexperienced, unsophisticated, and potentially compromised individuals, this situation is unprecedented. And remember, John Ray III has been the chief restructuring guy for Enron, Nortel, and many such companies. Now, this ought to have been obvious to investors. There are plenty of red flags, and you can say that this is the benefit of hindsight, but look at these facts. The FTX board had only 3 directors, and SBF, that is Sam, an FTX employee, and a lawyer in Antigua who specializes in gaming. During a Zoom interview to raise money from Sequoia Capital, Bankman was surreptitiously playing a video game. Now, this was obviously something that you would frown upon, but this was a bragging point in a profile on him commissioned by Sequoia. This is all available still on the net in the archives. The audit firm of FTX.com and similar exchanges in non-US jurisdictions was something called Prager Metis, whose website claims that they are the first ever CPA firm to officially open its metaverse headquarters in the metaverse platform Decentraland, whatever that means. SPF controlled Alameda Research LLC. This is where the real fraud happened, which was a crypto hedge fund applying strategies such as arbitrage, market making, yield farming, and trading volatility. It also offered over-the-counter trading services and made other debt and equity investments. Who controlled Alameda? SBF owned 90% and Gary Wang 10% of the company. Just that. There are no outsiders, nobody else. Alameda prepared consolidated financial statements on a quarterly basis, but it appears that none of these financial statements have been audited. The September 30, 2022 balance sheet shows 13 billion in total assets, which were mostly useless tokens issued by FTX. Subsequently, one of the investors, which is Tiger Global, said that they blame Bain and Company for not doing a proper due diligence, but it is Tiger Global which is investing. Why would you outsource the due diligence process to some other consulting firm? And what would the investors in Tiger Global think about that? Indeed, it seems insane that any seasoned investor, that anyone or anybody else could bother to give a second look at crypto or crypto-related business in any form until they were also part of the game and just wanted to flip or take advantage of a momentum, which is not really the first, doesn't fall within the first principles of safe and sane investing. Cryptos are completely speculative products which cannot be valued because they're not backed by anything. Successful investors like Warren Buffett and Charlie Munger of Berkshire Hathaway have consistently warned against the dangers of crypto. Charlie Munger actually likened them to venereal disease and said that anyone who sells them is either delusional or evil. Perhaps SBF knew all this. In several interviews, he did not even bother to counter suggestions that the whole crypto business is a giant Ponzi scheme and that many cryptocurrencies would actually be worthless very soon. Clearly, many first principles of investing were violated here. What about the first principles of regulation? Providing an effective regulatory environment for exchanges is not hard if first principles are followed. These involve segregating or preventing commingling of customer assets, a fail-safe clearing and settlement system, and a trade guarantee fund. Regulators also subject exchanges to regular inspections. It is inconceivable that exchanges would be allowed to issue their own securities that are backed by nothing and also invest in other worthless cryptos. This is exactly what crypto exchanges like FTX and Binance are allowed to do. On top of this, Commodity Futures Trading Commission licensed FTX to launch a crypto exchange and all related speculative products like futures, options, swap contracts on digital assets and other commodities to both US and non-US persons. Strangely, US laws allow this kind of shaky business to accept money from customers and allow lenders to loan them money. US regulatory caps also allowed FTX to grow enormously in the US as an offshore exchange. A large part of FTX is actually in Bahamas, where regulation is virtually non-existent. While it's true that every new development cannot be anticipated, every new fraud, ingenious ways in which the scamsters dupe us cannot be anticipated by the regulatory authorities with foresight, damage from new shenanigans can be contained, certainly if regulators follow their own first principles, of which are moving quickly when something does not smell right and are actually made accountable if they ignore red flags which are there in plain sight. FTX is part of a long line of crypto bankruptcies, such as Celsius, Three Arrows, which was a hedge fund focused on crypto, and Luna, which is another cryptocurrency. But regulators refused to be alerted. Even the Bernie Madoff Ponzi scheme could have been detected very easily if the Securities and Exchange Commission had acted on letters from a whistleblower. Usually, there are enough signs. And if you say that it's all suddenly become bankrupt and nobody knew, that's usually not correct. Somebody knows, somebody talks, and certainly there's regulators, if they're alert, they can sort of get alert, they can find out about what's going on much beforehand. In short, what happened in FTX is both investors and regulators are guilty of deviating from their own first principles, which allowed such a gigantic fraud to be perpetrated. And this is not going to be the last, certainly not last in the crypto world, as many more bankruptcies are certain to happen. If you liked watching this, please do share and please do subscribe. Thank you so much.